Bank of England has just released its latest financial stability report, which it publishes every quarter, and this one stands out. The main takeaway is clear. The risk environment around the UK economy has worsened. When the Bank of England, known for being conservative and cautious, openly admits that risks are rising, it's a strong sign that the outlook isn't good. They note that global economic uncertainty remains high, driven by geopolitical tensions, trade fragmentation, and stressed sovereign debt markets. All of this raises the chances of global shocks. Before we dig into what this means for you, make sure you're subscribed to Economy Ledger. If the bank is warning that risks are escalating, you need clear and honest analysis more than ever, because mainstream outlets won't prepare you for what's ahead. Rising cyber risk, fueled by worsening geopolitical issues and growing worries over AI asset valuations, are also high on the bank's list of concerns. Let's look at that last point. According to the Bank of England, current share prices of AI companies mirror the kind of overvaluation seen before the dot-com bubble burst in the US. In the UK, share prices are at their highest levels since the 2008 global financial crisis. This puts us in a position similar to the early 2000s in the US, or 2008 in the UK, where share prices eventually fell by about 40%. The bank warns that a sharp correction, essentially a market crash, is becoming more likely. Why does this matter? AI infrastructure spending is being funded through rapidly rising corporate debt. That means there is a direct line of risk running into the banking sector. As AI companies and credit markets become more intertwined, any trouble in AI investment could quickly spread across lenders and investors, with potentially serious consequences. The bank notes that a setback anywhere within the AI ecosystem could send financial shocks through the system in unpredictable but severe ways. This is making credit markets look fragile beneath the surface. For now, things may look stable, but corporate leverage is high. The Bank of England also admits that loan underwriting standards are weak and that complex, opaque financial structures are being used similar to what happened before the 2008 crisis. In other words, they are signaling that the same problems seen before the global financial crash are appearing again. Lenders are making weak assessments, and poor potential returns are being hidden behind complicated legal setups, making risk analysis much harder. To show how serious this is, the bank points to two recent major debt defaults in the US, demonstrating how losses can hit several parts of the debt market at once. The entire system is interconnected, much like in 2008, when Lehman Brothers collapsed and set off a chain reaction. The failure of one firm could pull down several others. The bank is stressing that investors must understand their true risk exposure and not rely solely on credit ratings, which have recently been too slow to adjust. In 2008, rating agencies labelled toxic debt as high quality. The Bank of England is warning that this same problem still exists today. The bank also highlights another crucial point. While the 2008 crisis was concentrated in the banking sector, today the risks are heavily rooted in the shadow banking sector. This includes private equity, private credit, insurance operations, and hedge funds, all of which have grown massively since 2008. This is one of their biggest concerns. The Bank of England is facing an unusual situation because they have never dealt with a potential downturn of this scale. They acknowledge the risk, yet they also admit they haven't fully considered the possibility that the private equity shadow banking sector could trigger a broader market collapse. In simple terms, they are signaling that they are navigating without a clear plan, which is far from reassuring. They also argue that many governments already have high debt to GDP ratios, limiting how much more they can borrow. They believe, although I don't entirely agree, that governments are pushing borrowing to the limit due to demographic pressures and rising defence spending. This could mean that if the banking sector were to collapse again, governments might not have the fiscal space to intervene. While I suspect they would still respond in a crisis, if this mindset continues, it could amplify risks in sovereign debt markets and even trigger a bond market shock. That would only make things worse at a time when we are already facing the risk of a credit crisis and a stock market downturn. The Bank of England also warns that the UK is vulnerable to global contagion. Even if the UK were in a stronger position, which the bank suggests it isn't, our deep links to markets in the US, Europe, Japan, and Australia make us highly exposed to stresses elsewhere. If one major financial hub comes under pressure, it could spread quickly, creating a domino effect. The real danger is that banks, driven by panic, might resort to fire sales and tighten access to finance when households and businesses need support the most. This would worsen the downturn and intensify the damage. The bank says this risk of panic and meltdown is increasing, and the UK is exposed to it. While the bank insists UK banks are resilient based on their stress tests, I remain cautious. These tests are designed by the bank itself, so it's no surprise the outcomes support their narrative. The real issue, as they admit, is not the banking sector, but the shadow banking sector, which remains untested and fragile. Their reassurances feel empty because they ignore the core problem, the unregulated parts of the financial system. If the shadow banking sector collapses, the supposed strength of the banks won't matter. Moreover, the Bank of England notes that one of the core purposes of banking, providing loans to businesses to drive real economic growth, is simply not happening. Small and medium-sized enterprises, which are essential for growth and job creation, are struggling to access credit. This is a serious problem because large banks and other parts of the financial sector are taking on excessive risk while failing to provide the funding that could support recovery through SMEs. It's a strange paradox. The finance sector, which should help the economy grow, is instead holding it back, while the real engines of growth are left without the resources they need. The Bank of England also tries to reassure the public by saying that household debt in the UK looks stable. While mortgage defaults remain relatively low, the reality is that many households are under heavy pressure. This is another point where the bank's comfort message falls short, because the wider financial strain on the population is intensifying, even if the immediate debt numbers look manageable. The bank understands that renters, in particular, are vulnerable to rising living costs and the broader economy's sensitivity to interest rates. In simple terms, they're warning that if a crisis hits, whether it comes from an AI-related market crash, a private equity failure, or a banking shock, the financial pressure will spread far beyond the finance sector. People trying to keep up with rent or mortgage payments will feel that pressure even more. Landlords, mortgage firms, and banks are likely to increase costs. This won't be a crisis contained to markets. It will reach everyone. The Bank of England is pointing to systemic risk that could hit the general public directly. One major risk they highlight is the £100 billion being speculated in UK gilt markets by hedge funds trying to make short-term gains. If the value of these funds suddenly shifts due to an AI crash, the fallout could be completely unpredictable. This is how crises often unfold, through cross-contamination, where a shock in one area triggers instability across several others. The bank's report repeatedly stresses that the level of cross-contamination is now so high that they cannot fully measure the potential damage, though they are clearly worried about it. Financial innovation is adding another layer of risk. Technologies like stablecoins, distributed ledgers, and the systems behind Bitcoin may look strong, but the bank points out they have never been properly tested. They admit they are still catching up when it comes to monitoring crypto asset risk. Crypto markets remain fundamentally unstable, as shown by their recent price drops, and while they may not be the cause of a full system collapse, they could make any crisis far worse. Another area drawing more attention from the bank is climate risk, which they now see as immediate and closely linked to financial markets. Extreme weather events, including floods, fires, and crop failures caused by rising temperatures, are turning into real financial risks. These events are making many assets uninsurable, which has huge implications for financial markets and for banks that depend on those assets for lending. The risk is being pushed onto households, many of whom now struggle to move or insure their homes. In the end, the government may be forced to cover these losses. Although the Bank of England recognises the growing impact of climate risk on financial stability, they admit they still cannot fully measure it. Even though they understand the issue, there has been no solid action to address it. Their conclusion is that while the core banking system appears strong, the risks around it are rising. These risks are growing, and the bank attributes this to overpriced AI tech markets, highly leveraged non-bank finance, and hedge fund behaviour, all of which create market opacity. These areas look fragile, but no one is entirely sure how deep the vulnerabilities run. The bank also calls attention to sovereign debt fragility, made worse by speculation, while too little investment is being directed toward adapting to climate shocks. On top of that, geopolitical tension adds even more unaddressed risk. Although the Bank of England claims the system is resilient, reading between the lines shows they are extremely concerned. They recognise the risks, but they don't know the full scale of them. This is a warning in itself. When an institution known for its caution signals this level of uncertainty, it means the risks are serious and that we should move carefully because a crisis may be close. In essence, they're suggesting we could be heading for the biggest crash yet. Their failure to anticipate the 2008 crisis, a point the Queen famously questioned them about, hangs over their analysis. They are determined not to be caught off guard again. So how should we read this financial stability report? To me, it shows that we aren't facing stability at all, but rather enormous instability. Everything I have been warning about, the coming crash, looks more inevitable by the day. The question is no longer whether it will happen, but when. The Bank of England believes it is approaching, and it seems clear that this crash is now on the horizon. If this opened your eyes, don't just close the video and move on. Make sure you're part of the few people who stay ahead of events, instead of being caught off guard. Like the video, subscribe to Economy Ledger, and turn on notifications so you never miss what's happening beneath the surface of the UK economy. Share this with someone who still believes the system is stable, because the warning signs are no longer subtle. And tell me in the comments what you think comes next. Your thoughts matter, and together we can stay prepared for whatever unfolds. Stay alert, stay informed, and I'll see you in the next one.